All right, friends, welcome to the introductory course of finance. Let us have a brief introduction and some key concepts that will help us drive all these other chapters that come next. So what is finance? And more specifically, what is financial management? Well, let us try to define it. Well, finance is anything that has to do with the management, creation, and the study of money, the investment of money as well. So how do you get the money and how do you invest it? How and why an individual, company, or government acquires the money needed? Why would any one of these entities need a fund, a capital? The government might need money to invest certain projects or to close a deficit. And a company might need money to grow. An individual might need money for personal reasons. So how do you get the money? How do you invest it? This whole process is what finance is finance, basically. So money is about the acquisition and the use of money by individuals, corporations, firms, government, and anything else. Now we have three types of finance. The first type is anything related to money, credit markets, security exchanges, financial institutions, or in other terms, the financial markets. The second part is the investment part. It looks at finance from the investor's perspective. The investor can be a corporation, a government, or a person. Where to invest, where to put your money, what will be the optimal investment decision. That, of course, will depend on what your objectives are. And then comes the financial management, which we will focus more on here. And it involves decisions made within the firm regarding the acquisition and use of funds. If you take any company, for the company to grow and survive, they need to get funds and they need to use these funds in such a way that they optimize their growth. This process is called financial management. Now in this course, we focus on number 3 here. Although in other courses, we will look at the institutional part, that is number 1, or the investment part, that is number 2. Although the 3 topics have a lot in common, they use a lot of similar tools. So again, this course is about financial management, how to raise money if you are a firm, and how to use it adequately in such a way that you optimize the value of the company. Now, what is the goal of a firm? Is it profit maximization? Well, although profit is always welcome, but in terms of perspective, it's not an engulfing type of goal. When I talk about profit, well, I ignore the timing of the returns and the uncertainty of returns. If I want to say that I just want to make $1 million, well, $1 million today is not $1 million 10 years from now. Okay? If I say I want to make $1 million, well, I'm not really saying how risky it is, because how risky it is will affect the value of this investment. Some investment could be highly risky, and other investment could be less risky. So the word profit is in itself not enough because it ignores many variables. So any well-behaved, decent firm or corporation will never set profit as a main objective. They might talk about profit, they might seek profit, but they have their eyes on something that is further away, that is more important. And that's shareholder wealth maximization. If I am a corporation, at the end of the day, what I want and what will measure my success is the value of the shares. If they go up, that means I'm doing something good. That means maybe I don't have enough profits now, but the perspective is very good. Or maybe I'm making very big profits. So ultimately, what I want is to maximize the value of the firm. Now keep that in mind. When you're doing financial management or corporate finance, the ultimate goal is to maximize firm value. And you will see a little bit in this course and in other courses, if you take other courses on this side, that this very simple sentence, that the goal of the firm is maximizing value or shareholder wealth, is actually a sentence that is very deep, that drives all financial management theory. So it boils down to maximizing the stock price. Ultimately, it's the stock price that I want to be maximized as a financial manager. Now, there are different forms of businesses. This is not really the place to discuss deeply each one of them. But we will focus on one of them because this is the goal of this series of lectures. You have what we call a sole proprietorship, a partnership. Well, the first one is basically a business owned by one person, one individual, that maintains the title and has unlimited liability. Okay? Unlimited liability means you can lose more than what you invested. You could invest $1 million in a project under this legal form. At the end of the day, you might make money, or you can lose money, or maybe lose more than the $1 million that you invested because you have unlimited liability. The partnership is similar, except that you have 2 or more owners. And then you have general partnership, where all partners have unlimited liabilities. And then you have limited partnerships, when you can have 1 or more general partners who have unlimited liability and 1 or more who have limited liability. So it's a combination of limited and unlimited liability under the limited partnership. A corporation is a business that functions separate and apart from its owner. So this is a key element. A corporation, you have a legal separation between the managers and the owners that we call shareholders. Unlike the other form of businesses, the manager is not the owner. The owners or the shareholders, they have a limited liabilities. They cannot lose more than what they have invested, unlike the other type of businesses. They tend to own certificate that we call common stock certificate. Well, nowadays these certificates, they don't look like what they were in the past, but they can still be called certificate, and they can be transferred in the market, meaning I can own shares of a company. I will be the shareholders. I have nothing to do with the management. Then I can transfer ownership. All I have to do is go to the market and sell this certificate very easily in the secondary market. and then the ownership will be transferred. So it's very easy to become owner and then sell your shares of a company, unlike other forms of businesses. Now, this form of business is very attractive from for different reasons. Well, it becomes very easy to raise funds. There is a huge flexibility in raising funds. It has for the corporation, right? They can borrow the money and issue stocks to get equity or money for investment, easier than the other ways of doing business. So it is very attractive. You add to that the limited liability, it becomes a very interesting form of business. Now, how do they really work? How do the corporation interact with the financial markets? Well, we have the corporations like Nike, like Coca-Cola, like Microsoft, like Apple, Tesla, you name it. There are hundreds of them, and some of them are giants like Facebook, Google, which is named Alphabet, etc. These corporations, they need money because they need to invest and grow. So how do they do it? Well, you have investors, the people who save money, the institutions that save money, the people who have money to invest, people or institutions or government or whatever you name it, right? And then you have the government in the middle. Now, the investor will give cash to the corporation, right, through the financial market, either through borrowing or through equity, and these terms will be explained later. In exchange for a certificate or securities, for example, I can go to the markets and buy common stocks of a corporation. So I give them money that they will use for investing, and against that they will give me a certificate of ownership, what we call a security, a common stock, or a bond. Then these certificate of ownership can be exchanged in what we call a secondary market, meaning once I have the certificate, I can buy it and sell it in the secondary market. If I buy a stock and I don't want it anymore, I can sell it right away in the market or later, whatever, very easily in few seconds. Depends on what kind of stock, but it's usually pretty quick. The corporation will use my money, they will invest it, they will hopefully make profit, generate cash, and they will use some of that cash to pay me, the investor. They will give me like dividends, for example, right? If a company does well, they will, or not even it does well, if it depends on what their policy is, they will pay their investors dividend. Some companies do not pay dividend, but that's another story. In that case, if you go to a company that does not pay dividend, then you will make money through capital gain. So I'll get cash flows from the corporation and I will pay taxes to the government. So this is in very simple terms how it goes. I can use some of these cash flows and reinvest them by buying more shares in a corporation, or I can enjoy them if I want to for another reason. All right? But some of the cash flows will make their way to me through dividends. We have what in the financial market, we have the primary market. That's when a corporation issues a security for the first time. Let's say when a company goes public, they become listed in a stock exchange. They have to go through a process that we call a primary market. because they have new issues. They have to go through a process that is well known. So this is like a first offering. You have the secondary market after these stocks have been issued. Well, they will change hands. They will in the market, you will have investors that will buy and sell them. And in that case, the money does not go to the corporation. It just changes, it's just the ownership that changes hand from one owner to another. However, it's in the primary market where the corporation receives the money that it can use for whatever investments are needed or whatever reasons are needed. So the secondary market is a market in which previously issued securities are traded. Now, although the money exchanged here in this market does not make its way to the corporation, well, the corporation has to make sure that the value of the company remains in the right place, because they might go back later to the market to raise new funds, and they want to keep their shareholders happy. So it is in their interest, even though they don't receive that cash flow, to keep the market as high as possible. Now, the initial public offering is related to the primary market, and it's the first time the firm's stock is sold to the general public. Now, the IPO process it's very specific and very well known. It goes through investment banks, it goes through prospectus and many other things that we will discuss later in this course. I will give more details about it later in this course. But it is well known that IPOs tend to overshoot in the beginning. Not always, but sometimes it does. A seasoned new issue is when a company goes back to the market for new funds. They are already listed in the market, they've already issued stocks a long time ago. Now, after many years or some years or some months, they can go back to the market and issue new stocks because they need new funds. So it's a new offering. They will actually raise the number of outstanding stocks by having a seasoned offering. Now, some general lessons to finish this introduction. Let me offer you some general lessons about what we have learned in the financial market throughout history. First, there is a clear risk and return trade-off. If there is more risk, than likely there will be more return. There is a positive, strong relationship between risk and return. If you are an investor and you buy riskier stock, on average, you will make higher returns. If you invest as a corporation or as a person in riskier project, well, on average, you will make more returns. Now, the key term is on average, because when you're saying that something is riskier, it means that there is a chance that it will go bust. So riskier means that the chances of going bust or losing is higher, but if you make it under these conditions, the returns will be higher. So on average, the returns will be higher. There is a time value of money, and we will discuss this in another chapter or another lecture. The money has value because we live in an environment that has interest rates. So $1 today is not the same as $1 tomorrow, or $1 today is worth more than $1 tomorrow. Cash is king, not profit. It's good to talk about profit, but cash flows is what matters. Profit could simply be just an accounting number that is not very relevant as far as it is relevant as far as accounting goes, or as far as reporting goes. But as far as the corporation and operation, it may not be very relevant. In other words, you can have high profits but no cash. Incremental cash flows, of course, when we compare projects, when we want to undergo new projects, we look at what will be the incremental cash flow of this project is. Markets are highly competitive. It has benefit and curses. Markets tend to be overall efficient at various levels. There is an agency problem that we will discuss later, or conflict of interest between, let's say, shareholders and management sometimes, and other type of agency problems. Taxes are very important. They can make you accept or reject an investment. Risks are not the same, and the financial markets are full of dilemmas and ethical dilemmas and ethical stories. The financial market throughout its history has thousands of ethical issues. The latest one of them is probably the financial crisis, and many more that we lived before and after. All right, thank you for watching and listening to the introduction. Now we are ready to get into more specific topics. So let us go ahead to the next lecture. Hello and welcome back, friend, to the second lecture of this course about Principles of Finance, Introduction to Financial Management. This time we will be talking about financial statements, taxes, and cash flows. So this is a little bit of finance mixed up with accounting. But it's crucial information for corporate finance and for financial reporting. First, let us talk about an income statement. What is an income statement? It is usually a profit statement, profit or loss, of course. It is a statement of revenue and expenses. It includes all revenues and all expenses. So the statement, what it does is that it takes a certain period of time, let's say a year or 3 months, and it focuses on revenues and expenses during that period. And there are some standard rules about that. It would look something like this. You will have your sales minus your expenses, and you get your profits. Sales are revenues. Expenses could be the cost of goods sold, anything that is related to selling whatever good you're producing. Operating expenses, maybe rent, maybe electricity, whatever. Could be marketing, could be administrative costs, could be financing costs if you borrow money to finance your project, and so on. And taxes, of course, is an expense. All right? Now, depending on what kind of business you have, the sales could have different configuration. It could be a good that is sold. It could be a service that is income from a service. Any type of business will generate some kind of revenues. So it will look something like this. Sales minus cost of goods sold. You would tend to have what we call the gross profit, which is the profit after the cost of goods sold are taken out from the revenues. Then you would include the operating costs like administrative, marketing, and so on. That will be the operating income, or what is known as EBIT. Very important number. Then you will subtract your interest expenses. The expenses of borrowing could be interest rates if you borrow money, if your corporation borrowed money. And then that's what we call the earning before tax. Then you tax that number depending on the tax rate. And then you will get the earning after tax. After you get that earning after tax, you will have to pay your shareholder dividends. You would start with preferred stock dividends. Okay? And whatever is left is the net income. And that's the income available to shareholders. Now remember, in the previous lecture we said that the goal of a corporation is to maximize shareholder wealth. So whatever is left after you pay your cost of goods sold, your operating expenses, your interest expenses, your taxes, and dividend to preferred stockholders, whatever is left belongs to the shareholders. And that's your net income. The real owners of the corporations. Okay? So this is a very simple, remember this is an introductory course. So we're looking at the simple way of looking at the income statement, of approaching financial statements. Now this first part are what we call operating activities, or activities that are directly related to the operations of the company. Whatever needs to be done so that the product can be sold. And the second part is the financing part. That's where you pay interest and dividends to shareholders. Okay? So the first part is operating, the operating activities of your income statement, and the last part is the financing section of the income statement. All right? Now, the second type of income statements that is very important is what we call a balance sheet. Now, what the balance sheet does, it takes one snapshot at the company at a specific time, and it would report the company's assets, short-term and long-term, the company's liabilities, short-term and long-term, and equity, all done at a specific point in time. So remember, the income statement is usually over a period of time, let's say a year. The balance sheet is a snapshot. It's a situation at one moment. All right. Now, this type of statement can provide a lot of useful tools, such as computing rates of return for shareholders, evaluating the capital structure, the financing position of the company. So it is a great snapshot because it will give you an idea about how much the company owes, long-term, short-term, how much does the company asset have at a specific time, how much was invested by shareholders, what is it worth at this time, etc. So the balance sheet is a snapshot. Now, once you combine the balance sheet with the income statement, as we will see in our next lecture, you can generate a lot of useful data that can help financial managers make good decisions. Now, the balance sheet will have two sides. The first side, usually the left side, is what we call the assets, the total assets. And some of it will be short-term and some of it will be long-term. The right side of your balance sheet will include two things. The first part will include all outstanding debt, all forms of debt, and there could be many. Some of it is short-term and some of it is long-term. The second part of or the lower part of the second part of the balance sheet will include information about equity, such as preferred stocks or common stocks. More specifically, a balance sheet would be designed a little bit like this. Well, on the asset side, you would have your current assets. Now, current assets are the short-term assets. The shortest term assets, the most liquid asset is cash. Usually it goes in order of liquidity. So current assets are liquids. The most liquid is cash. Then you will have any securities that you own as a corporation that are short term. Your accounts receivable, if you sold some items on credit. Inventories, prepaid expenses, and then you move on to your fixed assets that are usually longer term than current assets and less liquid, such as machine, buildings, land. And of course, you can have some other type of assets like investments, like patents, like copyrights, etc. Some of them could be intangible. All right, so these assets will tend to move in order of liquidity from the most liquid to the least liquid. Now, on the right-hand side of your balance sheet, you have liabilities and equity. The first part will be liability with current liabilities, that is short-term debt. Companies sometimes can actually borrow on the short term. They can have accounts payable. That means the things that they purchased, the corporation purchased but didn't pay yet. Accrued expenses, any type of expenses not paid for yet. Short-term notes, these are financial securities maybe that are short-term, right? That the company actually issued some securities to raise money for investing. Then you can move on to long-term liabilities like notes, mortgage, Could be some bonds as well. Then the last part is your equity, such as preferred stock and common stock, that is shown at par value. Okay? Plus paid in capital. Usually the common stock and paid in capital put together will reflect the value of the equity. Any retained earnings, right? When a corporations generate earnings, they might pay some dividends and they might retain some for future investments. Whatever is retained will automatically go to the balance sheet. Okay? So this is in a brief description how a balance sheet would look like. Now your assets, if we go back to the left side of the balance sheets, we said we had current assets, and these are assets that are liquid and can usually, liquid means that it can be converted to cash within a year. Now if you have cash, that's the most liquid you can be. You're already into the cash. But whatever can be converted quickly into cash is called current assets. And the definition of current is usually a year or less. Now it starts with cash and it goes on to marketable securities. Now usually if you take markets like the American market that is very efficient, most of the securities can be marketable very quickly and sometimes can be sold in an instant. Then you have the account receivables. Now the account receivables actually will depend on how fast or on the terms of your credit sales. So it can go from few days to few weeks, potentially a few months. Inventories, prepaid expenses, etc. Okay? These are all considered to be current assets. Now the fixed asset, on the other hand, it could be machines, building, equipment, land, anything that can take potentially a year or more to be sold is called a fixed asset. This is all part of your left side of the balance sheet. Now other assets, of course, they can be listed under in your balance sheet that are not current or fixed. It could be intangible assets such as patent and copyrights and other things. All right, now the right hand side is the financing part of the balance sheet, right? Now you have the debt, which is financing provided by a creditor. You have short-term debt, that is money that must be repaid within a year. That is, it can come under accounts payable, interest payables, taxes payable, accrued expenses, short-term notes, etc. All right, these are things that are liabilities because they haven't been paid for, and therefore they have to be recorded as a liability. And then you have the long-term debt, which can be a bank loan, which can be bonds, and we describe bonds in other places. It can be different type of debt instruments. Now the difference between a bank loan and a bond is that a bank loan is a bank loan that you get from a bank directly, and the bond is the money that you borrow from financial market by issuing a security called bond. If you don't know what a bond is, it will be discussed later in a future section. Now the second part of the financing section of your balance sheet is what we call equity capital. Now, as I said, financing comes into the two parts. The first part, financing, is we just described it in the previous slide, which is basically debt. Equity capital does not work like that. Equity is not something that technically you have to repay, but it's more of an investment of shareholders that are expecting returns, and shareholders are taking more risk because they know they can lose money. Okay, so you have preferred stocks, and preferred stocks usually is somewhere between a bond and common stock, because most preferred stock would actually pay fixed dividend, and they will have to be paid before common stocks. Now the preferred stocks already constitute less than 3% of all capital raised, but they are out there. Now, in terms of legally speaking, that is something that you have to pay. If you don't pay it, there will be some consequences. You will always owe money. Preferred stockholder is not really that, even though you have to pay dividends, or dividends have to be paid on a constant basis. If there is default, the consequences are not the same as in debt, in such a way that you can actually accumulate them. The corporation can accumulate, say the corporation does not pay dividends over 6 months, there could be a possibility of paying 6 months as accumulated dividends in one shot. Now the last part is the common stockholders, and the common stockholders are the owners of the business and the company, legally speaking. They don't manage it. If you remember, in the previous chapter we said that shareholders or stockholders are different from managers. Stockholders are just the investors. They receive whatever residual income there is. After everybody gets paid, all expenses are paid, including the operating expenses and the financing expenses. Whatever is left, and after paying the preferred stockholders as well, whatever is left belongs to the common stockholders. All right, let's talk now about the third type of statement, that is called the free cash flows. Remember, in lecture number 1, I said that cash flows are king. In finance, at the end of the day, we use financial statements like balance sheets, income statement, only to get to the final result, which is cash flows. Cash flows are king. So let's see how it works. Now, a free cash flow is a cash flow that is free, basically, meaning that is available to be distributed to the investors, both debt holders and equity holders. All right? So in other words, we want to know how much cash is left for distribution to the investors. And if you remember, you have two types of investors: the debt, the ones that are lending their money to the corporation, and the ones that are investing through equity. We want to know how much cash flow is available to them. Now, the approach we use is that the firm's operating free cash flows should be equal to the firm's financing free cash flows. That makes sense, right? The free cash flows from financing should be the same as free cash flow from operations. Now, what is the operating cash flows? It is the cash flow generated through the firm's operation and investments, right? This should be the same cash flow paid to or received by firm's investors. So whatever cash flows that is paid or received by investor is the same as the cash flow that should be generated with firm's operations and investments, right? So how would you do a free cash flows from operations? Now, you would take the after-tax cash flows from operations, you will minus the investment in net operating working capital, you would minus the investment in fixed and other assets, right? Again, you would take the after-tax cash flows from operations. That's the operating income where you revert back your depreciation, right? What is your income after operations? Now, at this point, you might be a little bit confused if you're not used to finance at all, but the operating income would include depreciation. Depreciation is not a real expense, so whenever you're doing cash flows, you have to revert back your depreciation. All right? So the after-tax cash flow from operations is the operating income plus depreciation. Now, once you do that, you have to subtract any investment in operating working income. Right? Now, these are your short-term investment and your short-term liabilities, right? So you take your current assets and you subtract any current liabilities that do not bear interest. For example, investment in net working capital. If your account receivable have increased, or if your inventory have increased or decreased, if your accounts payable have increased or decreased, etc. Now you take all that and you subtract the final part, which is the change in gross fixed asset. That could be buying, investment in a building or land or machine, or any other type of asset in the balance sheet like machine and so on. Now this was the operating perspective. Now the financing perspective, you will take the interest payment to creditors, you subtract any change in debt principal. That means if you borrow more, let's say if you borrow more, that means you have more financing coming in. That means your principals have increased. Any paid dividend to stockholders, any change in stock value, that will be the financing free cash flow. So any change in stock, not stock value, okay? All right, so at this point, we will come back to the cash flows in a future lecture, but this is an initial idea about how free cash flows work. Now, okay? Now, it is essential that you understand what is an income statement and what is a balance sheet if you are interested in finance really, especially in financial management. Because when it comes to financial reporting, all reports and everything is built around these two statements. Let's talk a little bit about tax rates. Now the tax rate, this is an example. I'm just giving you an old example here, but in reality this has changed. This is just to give you an idea how it works, or how it used to work and how it will be working in the future. A few years ago, when a company generate an earning, now remember the part of the income statement, the part that was called the earning before tax, that earning will be taxed. Now how is it taxed? The first 50,000 will be taxed at 15%, right? The second section, or the second part, whatever comes between 50,000 and 75,000 will be taxed at 25%. If you go to the 75-100 range, it's 34%, and so on. And over the 18,333,000, it becomes 35%. So if you, let's say you have a 20 million earning as a corporation, well, the first 50,000 will be taxed at 15%. Then the next section between 50 and 75 will be 25%, and so on. So you can have you can see how it goes. Now these rates have changed in 2017, and now the United States imposes a tax on the profit that is 25%, and it is flat, right? So it's not as complicated as before. The tax rate has decreased significantly, and this was pushed by Donald Trump, the president, in 2017, right? But this could have consequences, because the objective of doing this is just actually to make more money available to corporations so they can reinvest more and stimulate the economy more. And if they generate more income, of course they will will be paying more tax to the government, etc. Okay, so it will take few years to see if this actually works or not, because sometimes a fiscal policy such as this can backfire. Now in 2019, the corporate income tax raise was 230 billion. That means the US government got 230 billion from taxes, corporate taxes. In 2016, in 2017, it went down by 9%. So you can already, sorry, the 230 billion was raised in 2019, and that's 9% less than 2017. So the initial impression that we got is that the government generate less revenue from this tax decrease. To finish our lecture, let us talk about taxes again, just through an example. Let's say we have a corporation that has sales of 32 million. The cost of goods sold at 60% of sales, right? The operating expenses are 2.4 million. There is a 1.4 million depreciation. The firm has 12 million in 9.5% bonds outstanding. That means the company has borrowed 12 million and it will pay 9.5% interest. And the firm will pay 500 dividends in a year. Now I would encourage you to stop the video here and generate an income statement so you will know how much taxes you should pay. Okay, now let's put this information back here. These are your sales. Your cost of goods sold are 60% of your sales. So this number is simply 60% of 32 million, right? The operating expenses were given as 2.4 million. Your depreciation is 1.4 million. Therefore, your taxable income is 9 million. You pay the interest, which is, remember, the 9.5% of the amount borrowed, which is the 12 million, I believe. That is the taxable income. So the taxes will actually apply to this number right here. Now, if we assume we are before 2017, before the flat tax rate, then the first 50,000 will be 7,500. It will be taxed at 15% and it will give you 7,500 tax. Then between 50 and 75,000, if you remember the schedule, you will be taxed at 25% and so on. Then these amounts should accumulate to whatever income we had in the previous slide. Okay? if you add them, and this is the amount you have to pay the government. Okay, now this is, I'm just giving you an example of how to use to work, but now how it works is different. Now if you actually, you can use a shortcut, which is taking directly 34% of the 7,860,000. Why would you take 34% as a shortcut? Well, simply because the last part that you see here actually dominates all these numbers, right? Now the first bracket, 50, the first 50,000, the next 25, next to 25, and next to 35. If you put all this together, this is very small compared to this number. So you're basically just taxing almost 34% of the total amount. This was our income in the previous slide. So a very good approximation, if you have a very high income, is to directly take that 34% of that huge amount here. So your liability, or what you have to pay the government, is this amount. Nowadays it went, now look at the difference between 2017 and now. If you were in 2017 or before, this is what you would have paid, 2,672,400. But now you will pay 1,650,000. Again, before we had 2,672,000. Now you're paying $1 million less. Now you can see the big favor Donald Trump did to the corporate world. Same operations, same profit, but under the current scheme you pay much less than before if you are a giant corporation. Okay, well, thank you for watching this lecture. I hope it helped. First, of course, if you've never been exposed to what an income statement, a balance sheet, or free cash flow, you are probably confused. Ideally, it would be nice if you had at least a basic financial accounting class before, or some place where you were exposed to these terms. The objective for us in finance is to use this statement to actually do other things. This is why you would learn the details of this in previous classes such as financial accounting. But if you've never seen this, it will be nice to go on your own and read about it from different places on the internet or textbooks. Thank you, and see you in the following lecture.